I'd like to welcome everyone to the Money Mindset Mastery Podcast.
Sorry, I've been outdoors too much.
Yeah, I'm your host Jim, and joining me is my co-pilot Goose. Goose, how you doing today?
I'm doing well, and this is as all of our topics are exciting. We're going to talk about some portion of retirement, and I felt like this weekend I was a little bit in the retirement wave, which was tending to the garden, being outside, making sure my grass was well tended to, and of course, as any good Italian does, watering their driveway. So
I actually did that too. Well, this is take two for us. For some of you who join us and watch us live, we recorded this, or at least part of this episode yesterday, and then about 20 minutes in, all of a sudden, we disappeared. And the reason for that was my internet connection dropped, and it was gone for 4 or 5 hours. So we are going to attempt this recording once again. And today we're going to be talking about retirement tax traps, how to keep more of your money when you retire, because there's a lot of myths about retirement and retirement income that, Ryan, you and I come across on a regular basis, surprisingly enough. So we're going to maybe bust some of those myths and then provide some advice on how you can avoid paying some tax in retirement, because it's difficult to not pay any tax at all, right, Ryan?
that is correct. Unless you're a government official, and then you just figure out ways to otherwise. So, yeah, sun, I'm telling you, it's the sun.
They're knocking on your door today. Yeah. So anyways, the first thing we're going to talk about is why tax withholding still matters in retirement, because there is this one myth that, again, Ron, you and I come across on a regular basis, which is, well, now I'm retired, so I pay no taxes on my income. True or not true?
I hate to break it to people, but not true. So you will continue to pay taxes in retirement, and for some that haven't planned it, will tend to pay more taxes in retirement than they did during their working years. And I'm looking often at a lot of the people that hold pensions as one of the number one group of people that come to us and then have this conversation, not realizing that their tax amount will be increasing in retirement because of what they're receiving, and that comes down to poor planning with individuals that have given them the wrong information, or in many cases no information at all. And I think one of the big ones that we often talk about is RRSPs. I've said this in the past, which is an RRSP is like having a joint bank account with the government, because that's essentially what it is until you reach retirement. So yeah,
I know that's how you put it, and for me, I kind of put it as that refund that you get really is a loan that CRA is giving you, and eventually they're going to recollect, and that's going to be in the future, and most likely they're going to be collecting a lot more than what you receive from them. So it is really a loan, and we deal with this with a lot of clients where they think, well, I retired, so there's no tax on my Canada pension plan. Well, no, you do get taxed on that. There's no tax on my old age security. No, you do get taxed on that as well. Well, my company pension, I probably won't get taxed on that. No, you get taxed on that too. And surprisingly, if you start taking money out of your RSP, convert it to a RIF, that's all fully taxable income. And a lot of people misunderstand that. I literally just had a meeting today with a client that started to work with me with her retirement plan. And we talked about her RSP assets, and she has insurance. And she said, well, maybe I'm overly insured. And I let her know that we were going to go through the assessment to determine that. I said, but we're not only going to look at what the current need is for the insurance, but also what the future need is for that insurance, meaning the potential tax bill. And she asked, well, what do you mean by that? I said, well, you have this significant amount of money saved in an RSP. Her husband unfortunately passed away, so she has her kids listed as beneficiaries. And said, do you know what happens when you pass away to this RSP money? She had no idea. And she's been dealing with the banks all her life. So then I explained to her what would happen, and she was shocked by it. Because again, no one ever took the time to explain it to her. All they would do is she would go into the bank and they would say, what's your RSP contribution for the year? And let's put it into XYZ fund. And that's it. right? Not really talking about the future consequences and whatever else. And to your point, with sometimes people end up paying more in taxes in retirement than they do during their working years because they don't take into account they have their pension plan, CPP, OAS, and now the RSP that's coming in. In many cases, they are paying more than they were during their working years, which is unfortunate. And part of that too is because they also don't have any tax deductions as well, right? That's part of the reason. So yes, you do pay tax on a lot of these retirement income sources, and in many cases, you don't get to control how much, right?
I think that's a big second conversation when I have these conversations with people, usually around 5 years out of retirement, or in some cases, 3 months out from retirement, is really trying to let them understand like what is the income that's going to come in retirement. And that's why we often do cash flow planning with a lot of retirees, both in retirement and out of retirement, because once you're in retirement, you, for the most part, have this fixed income that's coming in. You know the amount that's going to come in because of, again, the government controls and lays out how much each month or however you take your RSPs, which is eventually a RIFT. They control the amount that's going to come. Your pension is already set for the most part as to what you're receiving, and then all the things as OAS and CPP, and again the discussion of when to take any and all of them might be saved for later on or another podcast. So
Yeah, and we always talk about net income, right? Because what's important is the amount that you receive, you get to keep and you get to enjoy and spend, right? And the gross income, some of that's going to CRA. So we want to make sure that we always work with net income. But there's other sources of retirement income because a lot of people believe that the retirement savings is an RSP, but you can invest in non registered investments. And depending on how they're structured and how those income distributions are made, there could be some interest income, which is probably the worst because you pay tax on 100% of your interest income. But then you could have some dividend income and also some capital gain, and there's preferential treatment on how that's treated from a taxation point of view. And then finally, tax free savings accounts. There is a benefit to putting money in your tax free savings account, and it helps you control your tax burden when you do retire. So you can take less from your registered assets if you need to and top up using a combination of non registered and tax free savings account, right?
yep,
Yeah.
yep.
So the RSP isn't the only way. Now, one of the things that I think people also get burned on in their first couple of years of retirement is how they owe money to the government at the end of the year, and they don't understand why. And what tends to happen is, for example, if you have an employer pension plan, the employer is going to withhold taxes based solely on what income they're paying you. They don't care about any other sources that you have. So if you're earning $50,000 a year from your defined benefit pension plan, your employer is going to basically withhold taxes based on that 50,000. They don't care if you have CPP on top of that and RSP money that's coming out and whatever else. No different with CPP and other sources as well. If there's any withholding, they're only going to base it on the income that they are paying you. So in many cases, people are actually not paying enough taxes from these multiple sources, and then at the end of the year, they get this big huge tax bill, and they panic. So one of the things that they can do, Ryan, is what to kind of avoid some of that.
Totally threw me off there. Um, that's right. TFSAs is one of the biggest ways
No,
to
no,
insure.
no, 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 no. Withholding. Adjust your withholding
Oh,
taxes.
okay.
Right? So basically, what you can do is, for example, you can go to CRA, and if they're withholding, let's call it 10%, you can ask them to withhold more. So that way you don't have that big, huge tax bill at the end of the year. Right?
Often I have these conversations with people that go to their employer and ask their employer to withhold more tax in that way. I've never actually gone the other way of going to CRA and asking that. But I often ask clients, hey, you can go to your employer and they will put aside some more money. And that way at the very end of the year, they're not getting shocked with a tax bill they're owing, which is often people want to put that money and take it for a vacation. instead of having to owe the money to the government so they can go on vacation.
So Ryan, I think you've probably had way too much sun hitting you today,
Yeah,
because we're not talking about people during their working years. We're talking
yeah,
about people who are retired and how they could actually minimize the tax burden, right?
that yes,
So, yeah, so what they can do is they can go to Canada Pension and request them to take more withholding, right? Their pension plan, they can request that more is withheld. But in many cases, we say to people, don't withhold more, because here's the thing, they're not paying you any interest on your money. CRA, so as long as, so if you file your taxes April 30th and you owe them $8,000 because you didn't pay enough tax, and you write them a check for the $8,000, you're fine. There's no penalty. And in the meantime, you've had that $8,000 sitting in your TFSA or
same.
non-registered account or whatever else, earning 3, 4, 5%. Even if you just keep it in a savings account at 2%, for example, right? So during that period of time that you're waiting to owe them money, at least you can make some money on your money before you write that check. But the opposite isn't true. If you overpay CRA and that you get a refund, they're not paying you that refund with interest, right? So typically we just say, put that money aside. Don't actually ask for extra withholding from these sources. Put it aside, write the check in April. In the meantime, you're collecting 2, 3, 4, 5%, whatever it is on your money. So are we back on track now, Ryan?
I Yeah, totally back on track. And yes,
Okay.
thank you. The sun is totally affecting my ability to think properly. But I was right on the TFSA at the very end. So put your money in the TFSA. So
Even though the topic is how to adjust your withholding, that's what we're
yeah,
talking about right
yeah.
now. So, anyways, let's get splash some cold water on your face. Let's get back on track again. Um, Now here, I mean, CRA does have its own online tools to estimate what your tax might be, right? So you can go to CRA, or if you want to figure it out, if you do want that more withholding done, talk to your accountant, right? So the bottom line is you can even go online. You'll find calculators to say, well, here's all my sources of income. What is the total amount of tax that I'm expected to pay based on these different sources of income? And then again, you can project that way, or just reach out to us and we'll help you out as well to determine that. But bottom line is, we don't think you should pay them more, accelerate it, or have more withholding. Just keep it in your bank account until it's due. Alrighty, smart strategies to minimize taxes in retirement. So, Ryan, what's the first one?
I'd say income splitting, if you have a partner, is probably one of the best ways. We do face people that are off not with a spouse. So, but if you have a spouse, and as we had a group on when it come to income splitting, it was a great way to have a dialogue of equalization of that. But income splitting is the answer. I'll
Yeah, and
take
that was
that,
that.
Alex.
Right, that was single seniors for tax fairness.
That's
Right, so
correct.
that
Yeah.
was a recording we did. We encourage you to check that out. That was about 6 weeks ago or so, and they talk about how it is unfair for a single senior when they're earning a lot of this taxable income. They end up paying more net tax than a couple taking the exact same amount of tax. Income splitting is an option if, again, you have a spouse, but sometimes that isn't an option. Timing RSP withdrawals before age 71. This one can be controversial, right? Because a lot of times it's, well, take out more when you're younger, there'll be less left over by the time you pass away. The problem with that is, what if you outlive the money, right? So you can control. Usually, we encourage people just to take the minimum every single month, and then kind of top up with some of the other assets to ensure that you're going to have full liquidity if you go past life expectancy. But that is something else that you can do in terms of timing on when you access your money. And here's the other thing I will say, from going back to the government controlling the narrative here. Right now, 71 is when we're forced to convert our RSPs to start drawing income. Why does CRA do that? Well, it's because once we start drawing income, we pay tax on that income, even if it's minimum. So that's the other thing as well. RIF minimums, there's no withholding tax. people misunderstand that. They think, well, there's no withholding tax, so there's no tax on it. No. You still have to report it as income, and then you're going to owe the tax man the following year, right? Anything above and beyond the RIF minimum that you take out, there is a withholding tax depending on the formulas. Um, so what CRA has done in the past, at least in my lifetime that I can recall, is I believe it was 2006, 2007, the conservative government at the time was going to force people to start drawing from their RIFs or their RSPs. I think it was 69 at the time. And then we had the global market meltdown, and a lot of people lost 30, 40% of the value in their retirement accounts. So then the government reverted back to the 71 again. So that way we weren't depleting accounts quickly. And then that kind of went out for a while. And then the Liberal government under Trudeau also introduced to reduce the age. And I believe it was either 68, 69 again. And then COVID hit. And at that point, they're like, you know what, we can't force people at this age. We're going to revert back to 71. So I wouldn't be surprised with all of the expenses that the country has taken on, all of the deficits that we're taking on as a country. I would not be surprised if at some point in the future, the current government, and this isn't to go after liberals, conservatives, because they both did it, but I wouldn't be surprised if they turn around and they say, you know what, we're going to now start forcing people to draw their money sooner than 71. So now that starts to create a tax income base for the government. The other thing they could do too is they might also increase the formula, right? So at one point they actually reduce the minimum amount so it's a percentage of market value. They could turn around and actually revamp that whole formula again and force us to take out more, so that way there's more tax money going to the government. So just keep that in mind when you're investing in registered accounts. You're playing a game. The government basically keeps changing the goalposts all the time, right? This is why we look at other options as well.
Yeah, and again, I want to, for education purposes too, for people at this time of the recording, age 71, that your RRSP, registered savings plans, turns into RIFs. So you have no choice. This is something that liras turn into lifts. This is something a lot of people don't realize that happens, is that it's automatically turned into no longer a savings, but now an income source for you. And again, as you just said, you have no control over that. The government is the one that controls this. So if they suddenly change it to 70, 69, 68, whatever it may be aware that a flip of the switch happens, and this is what we can't control. Often I get confused clients that are asking me like, well, I don't want to right now. And I said, well, there's nothing I can do about it. You have to talk to your local representative, right? So
I've had clients saying, I don't need it, and I'm already at X amount of tax bracket. This is going to push me to the next tax bracket, and I don't need it, right? And it's like, sorry, but these are the rules. We have no choice.
Yeah, and that goes back to, again, we're talking about retirement for those people that are 20 years out, 30 years out, to really talk about what your goals are further out than waiting until a year or two out or 5 years out, because then we can actually plan further and plan other strategies. And that's our next point is strategic use of a TFSA, or in some cases non-registered accounts, right?
Yeah.
So
yeah, that's another way we can minimize tax in retirement, where again, if you're taking your minimums on your registered accounts, meaning your RIFs and lifts and whatever else, that you can subsidize some of your income with the TFSA and non-registered to control the tax bill. So that's a very good point. Another one is charitable donations and tax credits. So if you're someone who's in a giving mood and able to, right, giving to charity will help obviously reduce your tax bill as well, right? And then there's a couple of other strategies that we're going to talk about. We're just touching on them, and we're not going to get into too much detail, but we have in other episodes. The first one is the insured retirement strategy. Do you want to take a crack at what this is, or do you want me to go for it?
Go ahead.
Okay. So some people buy life insurance for the death benefit. Most people buy life insurance for the death benefit. But if you buy a certain type of insurance product, you can actually use it for retirement purposes. And before you start coming at me saying it's not a good investment and you shouldn't use it, we're not saying this is what you do with 100% of your money. We're saying this is part of the strategy, right? So we're not saying take every single last dollar, buy insurance policies, and implement and incorporate the strategy. We're saying this is part of it, okay, out of your overall portfolio. But with the insured retirement strategy, what you can do is you can build those cash reserves. Typically, I prefer to use things like permanent insurance, not universal life, because there is an investment risk potentially associated with that. So dividend paying permanent insurance coverage with some of the big providers here in the country. That's what I prefer. The reason why we do that is there's no market risk. Once you earn the dividend, you don't lose a dividend, right? It's the good old fashioned what Einstein said about the effects of compounding, right? Now, the money, the cash surrender value grows sheltered, so there's no taxes that you're paying on those dividends that you're earning every year. And eventually you accumulate an X amount of what's referred to as a cash surrender value. So let's say the projected cash surrender value is $500,000. Now, there's a couple of ways you can access the $500,000 in the insurance policy. You can do a redemption from the policy, and that could trigger some taxable income. But what most people do is they collateralize that $500,000 cash surrender value. They take it to a bank. There are programs in place. This has been a program in place for 30, 40 years from ever since that I've been in the business. And literally it's almost like a reverse mortgage strategy, but you're using your cash surrender value in your insurance policy. You collateralize the 500,000, the bank will give you, call it 400 to 450,000 of a line of credit, which you then can use as income. Now, because you're taking money from a line of credit, that's not taxable income. With these programs, if structured properly, you don't have to make any interest payments on the line of credit. You only pay as you use it. And what you do is you capitalize the interest. So what that means is you're not making a payment every single month, but it is being tacked on to the total value of the policy. When you pass away, the bank takes what they've lent out in the line of credit, so whatever's owed, plus the capitalized interest on top of that, and then the balance death surrender or the death benefit, and there might be a partial surrender value that potentially can get paid out to your beneficiaries. So it's another strategy that you can incorporate to help manage your tax bill during retirement. And then finally, there's the reverse mortgage strategy. Do you want to take this one?
Well, we talked about it on a previous podcast, right? So,
yeah, with John.
Which I would say go back and watch that for more details as to going. But again, as you just mentioned, it kind of does the exact same thing as the insured strategy, right? And I think for all of these things, we're not telling people to do one or the other, but we often talk about layering and really diversifying and layering your strategy for retirement. So, and it is, again, going to an institution and being able to take out a certain amount of money against the home, and being able to use that money as a tax strategy, and at the same time as a way to fund your retirement without having to without having to worry about a lot of the other things that most people do when it comes to retirement. So, yeah.
Some people use reverse mortgages almost like as a last ditch effort, right? It's like the last thing you want to do because they can be costly as well. But again, they can be a very good tax planning strategy, also an estate planning tool, right?
Yeah.
Because I'll use just some basic numbers. If you have $1 million home and there's no mortgage on it, you pass away, it's $1 million estate asset that has to be probated and going through all the issues. However, if there's a mortgage registered on title, it's the net amount, so the value of the home minus the registered debt on the property, that gets probated. So if you had a $500,000 reverse mortgage, you've taken the money, you've invested it. We can put those in seg funds if you want to. So seg funds, that avoids probate. From an estate point of view, now you've turned $1 million real estate asset, that's probatable into a $500,000 probatable asset. So that's something to consider. So to your point, Ryan, we're not saying everyone run out and get a reverse mortgage, that it's for everybody. No, absolutely not. But in certain circumstances, it saved a lot of people from being forced out of their homes, not being able to retire, having to work a lot longer than they were able to, mobility issues, on and on and on, right? So it is a tool in the toolbox that you should consider as your overall strategy, right? Anything else you want to add to the conversation?
I think we covered it, and again, trying to keep this relatively easy for people to fully understand that there's many ways that we can put together a plan, and again, that's what we do between working with people through our cash flow plan and using PlanWorth to really strategize leading, especially leading up to retirement, and really focusing on what their goals are instead of, again, institutions out there are great at helping you accumulate to some extent your wealth, but not really telling you what the end result is. And that's what we're trying to do is try to educate to make sure you understand that, upon retirement, if you're fully funding RSPs and you got a pension, there's going to be some major tax hits that are going to happen.
Mm-hmm.
I think that's the biggest thing that I just wanted to reiterate through this is that too often clients come not being educated because they've been told one side of a story, but not the second half. The accumulation part is being talked about, but the deaccumulation part and the estate planning are rarely being talked about or planned with clients. And we just want to make more people aware that we're here to help support that.
Yeah, I mean, I'm going to use the famous golf analogy, Ryan, right? Where if you're looking to play golf, and I don't care if you're not a golfer, but I think most people understand the game of golf. If you're looking to play golf and you came to us and you'd said, hey, I want to play golf, and we offered you one of two things, either the ability of any players ever played the game or the clubs of any players ever played the game, which would you choose? Most people would say, well, I want the ability. I want to know how to play the actual game and have the skill set, right? Well, the ability is what we try to do, is we try to teach the ability, where typically when you walk into a bank, they're offering you golf clubs. It's here's my product, here's where you should put your money, here's the best rate, pricing, whatever else, right? Now, we all know we need the golf clubs to play that game. That's the bottom line. But if you don't know how to hit the ball with a club, you're useless. Doesn't matter how expensive the clubs are. So what Ryan is trying to say is come to us so we can actually teach you about money. We can teach you about all these potential issues that you will face based on your decisions you make today. Learn about how money works. And then after that, we will talk about the clubs so you can play the game, right? But don't get into that trap. It's online, social media. Look at our account, our portfolio fee. Here's the best product. Here's our best rate. That's what we're bombarded with. Those are the shiny clubs. Let's learn how to hit the ball first.
Avoid the water and the sand traps.
That's what I'm told.
Yes.
Right. And that's why when we put a plan in place, I've had clients ask about, well, where should we invest our money? Well, we don't know yet. First, let's see what the outcome is going to look like based on what you're currently doing, right? And then we'll decide everything else. So that's ultimately what we're trying to do here. So I guess to kind of wrap this up, bottom line is there are tools out there that you can use yourself in terms of determining what your tax bill is going to be. But if you don't have a tax advisor, if you don't have someone who specializes in taxation, you can reach out to us, reach out to your own advisor if you'd like, but we'd be more than happy to help you. And we can kind of help you work through some of those scenarios in terms of what's the amount you can expect to take home. We want to see what we refer to that big red number, right, Ryan? We want to see that number as small as we possibly can, because the bigger that number, that means the more CRA is getting. So that's what we want to work through with you.
The less your family and the less your charities and the less your legacy is getting. So, and that big red number is a pretty shocking number for pretty much every client we've ever done this with. So
it is. And the final thing I would say is if you hear from someone who says, no, 100%, this is where you put all your money, this is the strategy, there's nothing better than this, everyone should be doing it, that's a red flag. I think for us, as we make recommendations, it's, again, we talk about the toolbox. There's different tools in that toolbox. They're not they're not used in every single situation, but they are depending on the client circumstance. So look out for our past episodes, like and subscribe, share. We'd love to get this information out as much as we possibly can. And I think, Ryan, the next episode, I think we're skipping next week again, because here in Canada, we have Canada Day weekend, a long weekend. So we'll be skipping that. But the following week, it looks like we're hoping to introduce a new team member to the TVH team. So we'll leave it at that. Thanks, everyone. Have a great afternoon. Take care.